We are live. Welcome to the Portfolio Builder webinar update. No changes to the portfolio. We're in a waiting game to watch inflation fall this summer. Let's take a look at our current asset allocation. For the high risk portfolio, the unit of investment is coming in at $3,778, down slightly from last week due to a pullback in just about everything. We've had an interesting pullback week. Currently on the defensive side, we have 42 shares of UVXY per unit, representing only 4% of the portfolio. We have 98 shares of US Treasuries on the long end, leverage times 3 with TMF representing 21.45% of the portfolio. Again, that's a bet that the economy is going to slow down, interest rates are going to fall, and inflation is going to fall. So that's on the defensive side. On the offensive side, we are long Coinbase with 17 shares representing 29% of the portfolio, ticker COIN. Playing the AI revolution right now. We're long the big tech giants with FNGU. It's some of the biggest tech giants that are heavily invested in AI. Leverage times 3. That's our biggest position in the portfolio currently. Also, these are pretty much the only companies outside a few oil and gas companies that have gone up this year. So the S&P 500. Only a handful of companies are actually up this year. And most of those, luckily, have been in our play on FNGU. Again, that's 34% of the portfolio with 14 shares. Our inflation hedge is on oil. We'll likely double down, maybe even triple down on that as soon as we get closer to a Fed pause. We're actually anticipating one more 25 basis point rate hike May 4th at the next FOMC meeting. So if we start to get some cool data next month, we could anticipate the pause in June. That'll probably be when commodities really take off and inflation can start to become a problem again. So again, we have one share of NRGU representing 11% of the portfolio. Now, if you're a paid member, you can log in, type how much money you have to invest, and it's going to do the arithmetic to calculate how many shares to purchase. So we have this actually pulled back to a 5% drawdown versus 7%. Still up 20% on the year, greatly outperforming the S&P 500. And again, I don't see us making many changes until June or July. And the main change would be to take some risk off the treasuries, off of coin, off of FNGU, load up a little more on UVXY and load up more on NRGU. Because if inflation is going to start roaring back at some point, that could make bond yields go back up. On the safe growth portfolio, where we play a safer strategy with potentially less risk, we're heavily in bonds. And so currently on UVXY, we have 19 shares representing 3.3% of the portfolio. We have 114 shares of the long treasury bond leverage times 3 with TMF representing 43% of the portfolio. We're going for the value play in Asia with EEM times 3 is EDC, 12 shares, 17%. Again, emerging markets tends to outperform when the dollar is very strong, inflation is very high, and interests are very high, and you're expecting those to all fall, which is exactly what we think is going to happen for about the next 14 months overall. Perhaps with a little bounce once the Chinese reopening starts to really kick into the commodity sector. We're long GBTC, which is trading below par to give you exposure to Bitcoin with 22 shares coming in at 17% of the portfolio. And we're more worried about inflation because of the big bond position. So we actually have one share of NRGU representing 19% of the portfolio. Again, I don't see any changes until we get the next FOMC minutes and then get some more CPI data in. And we need better clarification that services inflation is falling to make any dramatic changes to the portfolio. This portfolio has a 3% drawdown in April and up 4.6% for the year. Okay, so here's the latest data. Last week we had 3 soft data prints. We had the CPI come in soft, we had the PPI come in even softer Thursday, and we had retail sales come in soft Friday. Market loved it, pushed Ethereum up and Bitcoin up considerably. Last night, we had a really hot UK inflation print, and someone liquidated a ton of Bitcoin overnight in a huge rush sell order, perhaps just to create volatility and capture some short positioning gains. but that seems to have stabilized. And again, UK is a tiny part of the global economy. When we look at Germany, China, Japan, and the US, the bigger countries are showing falling inflation. Here's the latest from the US, really illustrating that core services CPI remains sticky in red, while goods CPI has fallen back to target 2% inflation. So we do believe core services will follow suit in due time. Now, if we break this down with this color bar chart, you can see the greatest source of inflation in the last 4 prints by far is the green colored item, which is shelter. And we know for a fact that real-time data over the last 12 months has shown shelter or rent falling. Now, while it has started to bottom and come back up, as you can see, it's only been growing for the last 4 months in the official US core CPI. So the biggest component is likely going to shrink for the next 6 to 12 months. And this will be very bullish for interest rates falling and long duration assets. Now, to play the devil's advocate, we do believe that the medical care services, which went negative this month, will rebound. We're starting to see car prices and housing prices rebound, as well as energy costs. So still been sticky inflation. And that's why the bond market hasn't had a huge rally, because again, this inflation remains sticky globally and in the services in the US. Here's a breakdown of it, and you can see again, the energy component had the big drawdowns with negative prints, while the services, especially shelter and transportation services, had the highest level of inflation. Another chart comparing the core headline versus core versus headline, and again, we can see core has been sticky while headline has been falling. The headline came in at 5 when it was expected at 5.1. Meanwhile, the PPI came in 50 basis points lower than expectations. So all signs are aiming towards perhaps 3% inflation in several months from now, which should be very bullish for the bond market. Now, there's big argument as to whether or not wage inflation is causing inflation or if it's an effect of inflation. And so we do believe that the rising prices slowly forced employers to raise pay, and then it's not the other way around. And we're starting to see this play out now as wage inflation has been slowing since July of 2022. Still elevated, but slowing down. This chart is looking at the M2 year-over-year money supply dragged forward 16 months. If this is the best leading indicator of where inflation's heading, we're going far lower for about the next 14 months. And we do need to take into effect that the Chinese have started printing money aggressively as they now believe US inflation has topped out, which means they can get away with printing money without devaluing their currency too aggressively. So that would indicate we may have lower inflation for about 6 months, and then it may start to come back a little bit depending on how aggressive China gets. And again, also how much money the US government's pushing into the economy. The last 3 weeks, Biden's been dumping more of the strategic petroleum reserve to keep inflation down, even though they said they're getting ready to buy more. And again, this is going to help with keeping inflation down. China also has a huge reserve, which they can dump. And we've also seen Russia and other countries cut back. So they're doing that to make the prices go up, but China and the US have been dumping their reserves to fight against that to keep inflation lower. Here's a look at the Chinese monthly loan growth. One of the best periods for risk assets was 2015 to 2018, especially Bitcoin. And notice what China did. They were having a really bad time with the real estate market leading into 2015, and they pumped a ton of credit into the economy to keep everything going. And they're back at it again. Here's a look at the Chinese global inflation leading the cycle by 7 to 8 quarters. And again, this is pointing towards basically falling inflation towards the end of the year and then a rebound into 2024, based again on their credit cycle and when it really impacts markets on an inflation basis. The Fed stopped growing their balance sheet. We'll get a new update tomorrow, but they're back to doing quantitative tightening, and it looks like the run on banks has been resolved for the time being. There's a report out that UBS Bank might be the next target, but in general, we've seen all the calamity in the banking crisis really really shut her down with the emergency actions that had taken place. And again, it did reverse 2/3 of the last year of quantitative tightening in 2 weeks. We have massive money and money market funds collecting high interest rates. And once we do get inflation falling and the economy slowing enough, we're going to anticipate the Fed has to cut interest rates, which is going to shove trillions of dollars out of money market funds into stocks, bonds, and cryptocurrencies. So as soon as inflation really is breaking to the downside, and as soon as the Fed does respond by pausing rates or cutting rates, this could be a very bullish opportunity for markets to get a lot of money injected into it. Consumer spending, while slowing down, is still at really high levels. Chinese retail sales are getting back to really good levels as well. We still have healthy balance of trade in the US, but slowing down, showing less demand and less inflation. We got that negative 0.4 retail sales print. But again, if you look at the big picture, US consumers still very strong. Recent Bank of America credit card data showed a very strong consumer as well. So we're not seeing some sort of imminent recession happening with high levels of unemployment and some sort of stock market crash anytime soon. Banks continue to grow credit. They did pull back a bit in the last month, but again, generally everything looks super healthy in the global economy, and inflation's topping out and falling. So it's a very good time to be long markets. Chinese imports and exports still at healthy levels. A little bit of a slowdown in February. We'll get updated data soon. Okay, very good. So the charts week over week are very similar. I'm going to refer everyone back to last week's charts and go into Q&A now. So we're really going to be in a waiting game for a few more CPI prints before we look at any changes. What I will review really quickly and then go into Q&A. As soon as the Fed pauses, we want to get more exposure to NRGU and the safe growth portfolio. And we likely do that by trimming off some coin and FNGU and also topping up on UVXY. If oil's going higher, it's going to revalue stocks lower. That's what would make UVXY go up as well as NRGU. In the safe growth portfolio, we're overweight bonds. So I would likely make any adjustments in the safe growth portfolio to add allocation to UVXY from TMF and probably leave it alone from there. So those are the two trade alerts we see coming in a probably 4 to 8 weeks time span. John says UVXY has been not a good, yes, we haven't had a stock crash. UVXY is when stocks go down fast. It's actually been behaving a little bit better lately than it had for the whole last year. But yeah, I think NRGU is really your stock crash insurance if last year and this year is really the only asset that went up. Because if bonds are going down due to inflation, bonds don't work as a hedge. And if the inflation is slowly creeping up and stocks aren't tanking, then UVXY doesn't go up. So UVXY, TMF, and NRG are the three defensive plays we have in an inflationary environment. Although treasuries obviously haven't worked for the past year. They started to work really well this year, but they've been very volatile in the last month. TMF is the ultimate long play. He's asking if it's the ultimate play. Yeah, I see interest rates going close to zero the next 5 to 10 years. It's the only way they keep the economy going and financial system alive. So, but it's not going to really move until growth slows down and inflation's falling. So if we have a Goldilocks situation where inflation's falling, but the consumer's strong and sales aren't crashing, you're going to see something like EDC, FNGU, GBTC, or coin greatly outperform treasuries. If we get into a recessionary fear and earnings are actually collapsing and unemployment's rising and inflation's crashing, then TMF will be our hero. So in the safe growth, we're playing it safe. We really don't see ourselves losing money long-term with TMF, so that's why it's the big position. In the high risk, we are playing where we think we'll make more money in the short term, which is clearly in cryptocurrencies and tech stocks, where we're dramatically overweight. So yeah, the big question is, will the Fed over-tighten and will the economy crash? So high risk is betting that's not going to happen anytime soon, at least not for the next 6 months. and I'm pretty confident in that. The safe growth is saying, we're just going to play it safe. Like, we know we're not going to lose money in treasuries. We know inflation's coming down. We know these interest rates are way too high, way over any kind of normal interest rate, and that inflation is going to come down eventually. So the safe growth is being much more patient and playing an asset we're extremely confident will generate a return over time. With the high risk, we're saying, well, we think we could make something like 10 times the money in the short term than we would with treasuries, and that we're not going to enter a recession anytime soon. So it's really the big two differences in the way these two portfolios are allocated. So again, we'll have a Rebel dividend. You can replace your Coinbase with Rebel dividends if you're a paid member, and you can call Dean to learn about that. We'll have our Rebel dividend go out Monday and webinar Tuesday, and the next portfolio builder webinar next Wednesday. We're really just going to sit tight and watch these CPI prints come in. So I'll pull up the chart, but basically we really need services to fall. And we're highly confident that's going to happen because we know for a fact shelter is about to fall rapidly. And that's by far something like 70% of the inflation in the last print. But it was the biggest last month. And we know real-time data has been falling for about a year now. So we've got a good year of shelter falling as soon as their data catches up. The caveat is, again, we're seeing energy go back up. John's dying for some extra trailers. No, I really don't see anything worth putting our money into. We're playing the best of the best, top shelf. Just need to be patient. So everything's been kind of trading sideways here over the last month because the bond market's been very confused. We've had strong labor prints, so no signs of recession. We're still printing massive amounts of jobs. Unemployment's barely starting to rise. So yeah, we're really just, we want to let the inflation crash, capture the profits on the bonds and the tech stocks and the crypto, and then we need to pivot towards inflation coming back from the Fed pausing by going aggressive in NRGU. So I got you a little position in NRGU. As soon as we've seen inflation really crash and the Fed's actually reacting to that by pausing and starting to signal rate cuts, that's what's going to make inflation come back and NRGU fly up. Gary says, if shelter drops and interest rates go back down, does the shelter increase again quickly? Yeah, good question. That's a good question. So we'll keep a close eye on it. Luckily, we can look at real-time rent data, and it doesn't show up in the CPI for a year. So, so far, the housing market has rebounded a little bit. Used car autos have rebounded a little bit. Baltic Dry Index has rebounded a little bit, but they're both down significantly from the elevated inflation days. Another big thing is the tax receipts this week need to be over 150 billion, or we're going to run out of money. Last year it was something like $360 billion. So we had extraordinary tax receipts last year. Our deficit totally this year is supposed to be 1.1 trillion or 1.3 trillion, and they've already spent 1.1 more than they made in this first 6 months of the year. And again, their fiscal year goes back to November. So the Treasury Department has a big issue. Interest payments are sky high because we're issuing a lot of short-term debt at ultra high interest rates. If tax receipts come in low and the Republicans block increasing the debt ceiling, June, July, August could be volatility. Another reason to be long those treasuries and be a little more defensive on the safe growth side until that roadblock is removed. Any other questions? But yeah, this is probably the most important chart. They have cut the money supply aggressively, and they're going to have to start pushing it back up again. to save the U.S. Treasury market, essentially. We can't do quantitative tightening, run $2 trillion deficit, and keep interest rates at 5%, which is where they're going to go to next month, and keep the government running. So. Okay, very good. Well, thank you guys for joining us live. We'll review the charts next week. I skipped it this week just because they're very similar to last week. Feel free to open up last week's webinar if you want to look at all the charts. But again, I don't see us changing positions for around 4 to 8 weeks while we wait for inflation to fall and then capture big gains on what I believe will be cryptocurrencies and tech stocks and bonds. Once we've captured a big profit on that, we'll roll it into an inflation hedge and the UVXY, expecting inflation to come back roaring, interest rates to rise again, and for stocks to revalue lower. Again, that's if we get the inflation coming back, which we think, based on the Chinese credit cycle, will be towards the middle to the end of this year. Okay, thank you guys so much. We'll see you back on Tuesday for Rebel Dividends webinar and Wednesday for Portfolio Builder webinar. And again, I'll wait a second for any last questions and put up our disclaimer. But yeah, we're sitting good. We've had some good returns for the year. And as soon as inflation falls, we're going to really cash in on our current positioning and then adjust. So thank you guys so much.